Welcome, everyone, to today's Pangea-Risk Insight webinar, After the War, Global South Trade Opportunities. Thank you for joining us today. Before we begin, just a few housekeeping points. The session is being recorded and will be made available to Insight members after the event. Throughout the discussion, please feel free to submit questions using the Q&A function, which you will find at the bottom of your screen. We will be monitoring these questions throughout the session and will reserve time at the end for audience engagement. Questions can also be asked directly to the team during that time. With that, I will hand over to our CEO, Robert Besseling, to introduce today's discussion, our speakers, and kick us off.
Thank you very much, Gabrielle, and good afternoon, good evening, or good morning, everyone, from wherever you may be joining us, and welcome indeed to this webinar. In fact, we had a webinar like this a couple of months ago when we were trying to forecast the impact of the conflict in the Middle East and the supply chain disruptions globally, particularly on the Asian, African, and Middle Eastern markets that we cover. Now, it is almost 4 months since the start of the conflict, and as our lead Gulf analyst told our team last week, or in the beginning of this week, in fact, this is the best chance of a de-escalation over that 4-month period. So we have therefore put together a perhaps ambitiously titled After the War, Global South Trade Opportunities. My name is Robert Besseling. I'm the CEO at Pangea-Risk. I'll be introducing the other speakers and my colleagues as we go through this webinar. What we have done is we are looking back particularly at the global secondary and tertiary impact considerations of the Gulf War on all the emerging and frontier markets that we cover, but in fact on the entire world, looking at various different issues such as energy, supply chain, security, political risks, security risks, etc. That's what we are going to be referring to throughout this presentation. And the good starting point, therefore, is obviously in the Middle East. So I'm going to introduce our first speaker, Bilal Bassiouni. He's our head of risk forecasting and indeed also our lead Gulf and Middle East analyst. Bilal, it was indeed you who said, perhaps ambitiously or realistically, that this is the best hope of de-escalation over the past 4 months. So, let's take a look at the Middle East region. What does the Iran and US agreement look like? Will it hold? And what should we be expecting in the coming 60 days?
Thanks, Robert, and it's lovely to join everyone on this webinar today. Thank you for joining. Yes, actually, the outcome of these ceasefire talks were accounted for in our scenario mapping exercise that we carried out a few weeks into the conflict. So we have forecasted that we'll likely see momentum towards one of the de-escalation scenarios and then move towards a more consolidated form of framework or negotiations. And in our view, the agreement is more likely to hold in its minimum form over the next 60 days. Both Iran and the US have reasons and have demonstrated throughout the past few weeks incentives to avoid renewed escalation. Iran needs export access, the asset relief that has been thrown around in the conversations, and the reconstruction finance, and these have all been used to incentivize the Iranian counterpart. And also the US is more eager for calmer energy markets and to reduce the pressure on its Gulf partners. So these are all positive in the sense that there is more incentive than what we saw in the earlier stages of the conflict. But I believe the central test is whether the US can and will be able to restrain Israel's independent military posture in the region. Iran will use that to treat that particular issue as the real measure of the United States' control over the process. So if Israel maintains a maximalist security posture, especially through its operations in Lebanon, or threats against Iran's nuclear infrastructure, Iran could then use that to slow implementation or widen the gap between the US and Israel. On the nuclear side of the conversation, also the sanctions issues, they are quite difficult and technical, but they seem to be negotiable in stages, which is why they are likely not to be the cause of breakdown in the conversations at this stage. Inspections can begin with the agreed sites and expand over time. And also oil waivers can be extended without a full sanction settlement. So none of that requires a final political settlement in the first 60 days. So the most likely outcome is a limited extension or a technical implementing agreement by mid-August 2026. A full settlement could be a bit more ambitious in that time period, Robert, but the real test will be whether the US can keep Israel inside a disciplined security framework while giving Iran enough visible relief to stay engaged in the conversation.
And obviously, Bilal, in that 60-day period, the Strait of Hormuz, the maritime passage through the strait, is another key indicator of success. But let's crystal ball. In a few months, and by the end of the year, what does maritime traffic and, as you said, tolling through the Strait of Hormuz look like?
So I think maritime traffic through the strait should rebound and possibly even rebound faster than market confidence. The ships can move once the temporary routes are clear, and also once Oman's coordination remains and continues to be in place, and vessels receive safe passage instructions. The commercial system, however, will take a little bit longer to normalize because, as we know, insurers, ship owners, and crews will want evidence that repeated transits are occurring without harassment or sudden rule changes. The tolling question here is the unresolved commercial issue. But in our view, that the first 60 days, passage is expected to remain toll-free. After that, Iran is likely to avoid the language of direct tolls and move towards a softer charging structure. That could include passage permits and compulsory insurance or safety charges, and those type of costs could be added. The US will definitely reject any compulsory Iranian charges, but shipping companies will judge the issue through sanctions exposure and operational risks. If a payment appears linked to Iranian state or security entities, insurers and operators will be cautious even if the fee is described as a technical charge. In essence, traffic can rebound quickly because the backlog is large and Gulf cargoes need to move. A return to pre-war conditions will require more than just open lanes. It will require several weeks or even months of clean passage, lower risk pricing, and no contested Iranian fee demand. And also something to monitor, as I mentioned in the first part of the question, is Israeli and Iranian action that could reset the insurance market once more.
Indeed. Bilal, I noticed there are quite a few attendees on this webinar from the Gulf region. So can we put this into the context of the Gulf? Has the Gulf region grown more resilient on the back of the conflict? What lessons have been learned, essentially? And particularly, we've been publishing quite a bit about energy supply diversification in the Middle East. Could you tell us to what extent the Gulf region has learned lessons and grown more resilient?
I mean, the Gulf region has seen the brunt of the disruptions during the course of the conflict. So it's difficult to come up with silver linings, but this is one real opportunity for the Gulf countries, which they have manifested, and we've seen a lot of movement towards. So the Gulf has grown more resilient, but the improvement has been concentrated mostly in Saudi Arabia and the UAE. Saudi Arabia has been able to use the Red Sea access and its east-west pipeline to reduce full dependence on the Strait of Hormuz for crude exports, and a number of projects that will bolster that transition from the Arabian or Persian Gulf towards the Red Sea is now in place. The UAE has also relied on Fujairah, its storage capacity, and the Abu Dhabi crude oil pipeline to move part of its export system outside of the strait. Now, those assets can give both countries practical options in the future during any forms of disruption and allows them to restart flows faster once conditions improve. The weaker points remain Qatar and Kuwait at this stage. Qatar's LNG exports are still heavily reliant on the Strait of Hormuz, and there's nothing at the moment, or no equivalent alternative route at current scale. Kuwait also remains highly dependent on Gulf maritime access and has fewer practical bypass options. Also, Iraq and Bahrain face similar exposure in different forms. But I think in the long term, these countries are also likely to put measures in place to bypass the Strait of Hormuz and reliance on one strategic strait.
Let's look a bit further than just the Gulf region into the wider Middle East, even North Africa. Bilal, it's difficult to say that countries have benefited from the war, but let's put it into perspective of which countries are coming out of this cycle of volatility, perhaps faster and more sustainably than others.
Yes, so from the Gulf region, it appears that Saudi Arabia is the clearest Gulf outperformer. It has the strongest mix of domestic demand, Red Sea access, as I mentioned, pipeline redundancy, and also fiscal capacity. So during the disruption, its internal market and West Coast logistics gave businesses more room to adjust. That supports a stronger recovery path as shipping and insurance conditions does improve over the coming few months. Oman is also a quiet beneficiary here. Its advantage is about its corridor relevance and its strategic geographical positioning. The crisis has increased demand for Oman's neutral coordination, the alternative ports it provides, and the practical communication that it can also establish with Iran. So this gives Oman a stronger role without requiring it to be a major energy exporter. Egypt benefits, as you mentioned, part of the latter countries that have cut their losses. So a calm regional environment supports its tourism, remittances, and Suez-linked activity, but also maintain its Gulf investment pipeline. So Egypt still has a major debt and balance of trade crisis, but the reduced escalation helps stabilize the external account and the investor sentiment. One of the more less reported countries when it comes to benefiting from the developments in the region has been Syria, particularly around the narrow opportunity presented for rerouting, particularly to the Mediterranean Sea, overflight activity, logistic discussions, particularly with Gulf interest in infrastructure. Yes, the operating environment in Syria remains quite difficult and challenging, but the reduced regional escalation can make Syria more relevant as a corridor and a reconstruction linked market over the coming few months.
That's very interesting. We'll definitely be monitoring Syria here as a potential dark horse. Bilal, thank you very much. I'm sure we'll cycle back to you later on. I'm keen to talk about those markets that have been proven to be almost over-dependent on the Gulf region in terms of energy supply, petrochemicals, and other supply chain issues. That's Europe, that's Africa, and indeed also Asia. And what we have been publishing extensively on the Insight platform about is the risks involved for Asian supply chain and trade, but similarly, the opportunities now coming out of this conflict and to a cycle of de-escalation, the supply chain and intra-regional opportunities. Now, this is the point where I'd like to introduce our colleague Saif Islam, our head of Asia forecasting. And Saif, you've actually spent quite a bit of time on this over the past few weeks and months in terms of how is Asian trade likely to evolve following the war, and what will intra-regional trade between Asia, Africa, Middle East, Europe even look like in coming years?
Yeah, hi Robert. Hi everyone. I think we will see several important shifts in Asia's trade landscape going forward. The first big shift is that energy security will sit much closer to the center of trade strategy. As you say, Asia was the most exposed region to this crisis because so much Gulf oil and LNG ultimately goes to Asian buyers. So even after a peace deal between Iran and the US is finalized, companies and governments will be conscious of the risks associated with the Strait of Hormuz and the Red Sea. So I think we will obviously see more long-term supply contracts, more use of alternative suppliers, and more investment in energy storage, refining, and shipping resilience, of course. The second shift is that trade routes will become more diversified. Obviously, Asia-Gulf trade will remain very important, but at the same time, businesses will price in higher geopolitical risk. So we should expect more interest in alternative corridors such as Central Asia links, Indian Ocean routes, also certain Gulf ports which sit outside the Strait of Hormuz, and more regional supply chains within Asia itself. And then last but not least, I would say the third shift is that intra-Asia trade should become even more important. Asia is not just an export platform for the US and Europe anymore. It's also a huge end market. And so from that point of view, China will remain central, while Southeast Asia will continue to benefit from the China plus one manufacturing model. India will try to capture more electronics, pharmaceuticals, automotives, and industrial supply chains. We have Japan, South Korea, and Taiwan, which will remain critical in high-end components. And of course, looking at beyond Asia, I think Asian trade with the Middle East and Africa will grow in strategic importance because regardless of what's been happening, Asia will need energy, critical minerals, and new consumer markets. And at the same time, the Middle East and Africa will need infrastructure, machinery, technology, and other consumer goods. And fundamentally, that will create more opportunities, not only for exporters, but also banks, insurers, logistics firms, and investors that can support trade between these very important regions.
Saif, you mentioned a couple of sectors there, and maybe there's a few more that we can just shortlist in terms of the sectoral opportunities within Asia that you see.
Yeah. As I said, there are multiple areas of opportunity, such as energy, shipping and logistics, food, fertilizers, because the conflict really exposed the risks around fuel supply, maritime choke points, and food security. There will also be opportunities in industrial equipment and financial services linked to more resilient trade going forward. But a really interesting, but perhaps obvious opportunity is renewables and electrification, right? That includes solar, wind, batteries, EVs, grid equipment, because the war really reinforced a basic point for Asian governments, which is energy security is no longer just about securing more oil and gas. It's also about reducing exposure to imported fossil fuels and volatile prices. So that creates a major opportunity for Asia because Asian economy is already central to clean energy supply chains. As I said, China is quite dominant in solar batteries, EVs. South Korea and Japan very strong in batteries. Southeast Asia is becoming a stronger manufacturing base. India is trying to scale up solar manufacturing and EV supply chains. So I would expect growing demand from the Middle East, Africa, and South Asia for various clean energy products and components.
And Saif, what about Central Asia? You've skipped that part. A big region to still talk about. There's a lot of logistics corridors running through this particular region. You have other opportunities on the back for Central Asian countries?
Yeah, absolutely. I mean, the middle corridor, for example, has gained importance since Russia's invasion of Ukraine, and now also because of ongoing conflict and uncertainty in the Middle East. Countries, companies, they are looking for routes that reduce reliance on Russia and avoid these vulnerable maritime choke points in the Gulf. So we are seeing an increase in trade through the middle corridor. And for Central Asian countries, this is fantastic because it improves links to the Caspian Sea, the South Caucasus, and of course, Europe. And it can also generate transit revenue as you also know, various big powers, whether it's the US, Japan, South Korea, they are looking for alternative sources for critical minerals and diversify away from China. And Central Asia can potentially play an important role in this regard, but perhaps it's a long-term game here. But with that said, the middle corridor still has real capacity constraints because there needs to be, frankly speaking, more investment in ports, railways, roads, and various Caspian shipping links across several countries. Customs procedures, for example, need to be better integrated because goods are passing through multiple borders. And China has invested actually in some middle corridor linked infrastructure, but it has not yet fully committed across the whole route. So overall, the corridor and Central Asia has potential, but it's still far from being a fully reliable alternative.
Every time I look at this great map of the middle corridor, I get the travel bug. Just want to get on a train and try out this middle corridor site. But in the context of Asia, I mean, there's a big red panda in our virtual room as well, right? So you've mentioned China several times. Can you explain whether China comes out of this crisis more resilient and whether the country can even gain from the outcome of the conflict?
Yeah, well, China has come through the crisis relatively well compared to many other Asian economies. Of course, it still depends heavily on Gulf energy. So it was exposed to higher oil prices and shipping disruptions like everyone else. But it also had important buffers, including large energy reserves, diversified supply relationships, particularly with Russia, and a much stronger domestic clean energy base than most countries. And that resilience has certainly given China some economic and geopolitical advantages. Geopolitically, I think the war strengthened China's argument that the US is perhaps overextended, unpredictable, perhaps a bit too reliant on military power. And as such, China can present itself, especially to countries in the global south, as a more pragmatic partner focused on trade, infrastructure, and energy security. And then economically, the crisis has increased demand for exactly the kinds of products China is strong in. For example, if countries want to reduce vulnerability to fuel imports, China is well placed to supply, whether it's solar panels, batteries, EVs, grid equipment, and other clean energy products. Last but not least, I think the conflict also reinforced the logic behind the Belt and Road Initiative because China will keep looking for alternative trade routes and logistics options. But I also think that the BRI will probably become more selective going forward, with China primarily focusing on projects that improve resilience without creating excessive debt or political or security exposure.
Agreed, and that's very interesting. I'll definitely be keeping an eye on the role of China intra-regionally and within Asia, of course, as well. Saif, please stay on the line because I'm sure there will be questions on some of your key points. But in the meantime, I do note that a lot of our attendees are either focused on Africa or indeed sitting in Africa. I can see people based in Cairo, in Nairobi, in Mauritius. So I think, Zainab, this is the right time. You've been patiently waiting, but this is the right time to focus on the African continent. And maybe one of the key issues that we've been tackling at Pangea-Risk over the past few weeks in particular is energy resilience. And coming out of this Gulf War, are there any opportunities for both the African importers and, of course, also the producers?
Thanks, Robert, and good afternoon to everyone attending. So the Gulf conflict has really exposed the weaknesses in Africa's energy system. We saw this in recent years, and now this is just yet another event that has us thinking about how to build resilience on the continent. So while several African countries produce oil and gas, the continent still imports a large share of the refined fuel that it consumes. And for import-dependent economies, this quickly feeds into higher transport and food costs and increases the pressure on foreign reserves. Now, although the shock earlier this year has been perhaps less extreme than when Russia invaded Ukraine, it has still been challenging for countries that have limited fiscal space. And we have seen a slight increases in inflation in many countries. And what we also see in the visual that I think is just before this, that was on screen, is that many countries are vulnerable where reserve levels are limited and fuel accounts for a large share of the import bill. But we would like to focus more on the opportunity side. So at the same time, the disruption is also creating an opportunity to build stronger regional fuel supply chains. So I think the most clear example in this sense is Nigeria's Dangote refinery. This has reduced Nigeria's dependence on imported fuel while also supplying fuel to other African markets. And now there are refinery projects that are gathering pace elsewhere on the continent. And this is what is currently displayed on screen. So we've got some in Angola, as well as in East Africa and in the West. And the opportunity for African producers where they can facilitate longer term gains is not simply just benefiting from higher fuel prices, but rather to process the oil locally and also become reliable suppliers to the neighboring markets. And then on top of that, there's also opportunities that go beyond just refining. It includes countries that can benefit from the supporting infrastructure too. So, for example, Tanzania is not an oil producer itself, but it's got the pipeline running through the country connecting Uganda's oil to its port. So this just shows that there are some opportunities emerging for non-oil producing countries in this context too.
A lot of what you just said, Zainab, actually reminds me of the messaging that came out of the Africa Energy Week conference last week. And I've suddenly realized that one of our participants actually was at that conference last week. Gabrielle, you attended the Cape Town Africa Energy Week. I'm calling on you unexpected because I know you are not scripted to comment on the on energy matters, but you were at that conference. Can you give our attendees a quick feedback of the Africa Energy Week and some of the big messages that came out of that conference?
Of course. Thank you, Robert, for the question. And thank you all for joining today. Reflecting back on some of the conversations I had last week, I think some of the clearest messages that came out of the Africa Energy Forum and perhaps were amplified in the context of the recent Gulf conflict is that energy security and industrial competitiveness are becoming increasingly tied together. And I think this latest disruption has really reminded governments across the world, but African governments in particular, and investors, that access to reliable energy is as much a development objective as it is a strategic necessity. So what really stood out last week was the sense that Africa is actually incredibly well positioned to benefit from what we're seeing as a global reconfiguration of energy suppliers. And I think both Bilal and Saif sort of alluded to this reconfiguration. And so there's growing interest in African energy, in African infrastructure, industrial projects, as investors look to diversify their risk. And of course, as there's a need to build more resilient trade and investment corridors. I'd say now the focus is very much on getting projects financed, getting projects built, moving away from a focus perhaps that was on power generation before into transmission, and then, as Zainab touched on, ports, logistics, industrial infrastructure to really support that. I will say that there was one final takeaway from last week's presentations, but also discussions on the floor. And that was the strong recognition around perceptions of African risk and that these do remain outdated. Better project performance data, particularly in renewables, and that's something that Saif touched on in Asia as well, is certainly in the spotlight and helping to challenge some of those old assumptions on the continent and unlock some significant investment and opportunity in renewable energy infrastructure on the continent.
Gabrielle, thank you very much. No one is going to believe that was unscripted. That was a great feedback on the Africa Energy Forum, indeed, AEF. Just a reminder that there is a Q&A box at the bottom of your screen. Feel free to drop a question into that box, and we'll certainly circle around to your question shortly. Maybe Zainab, let's stick to Africa for now. You've been mentioning a lot of the infrastructure back of the energy sector, but in broader supply chain and logistics. We talk about railroads, roads, pipelines, as you mentioned. Much of that financing has been coming from the Gulf region over the past decade, at least. In the perspective of Gulf financing, do you see that slowing down or picking up momentum again? Or do you see other big projects kicking off on the infrastructure side in Africa over the next few years?
Yeah, I think I'll start off with the Gulf financing part of the question. So we don't foresee Gulf financing necessarily moving completely away from Africa. What we might see is that investors may become more selective, specifically if security and reconstruction costs at home increase. But Africa will remain important, and Gulf interest in African logistics, renewable energy, and also critical mineral projects will remain strong, not only because they are important for trade, but also because it serves the Gulf countries' own priorities to diversify their economies beyond oil, but also to maintain access to essential goods, specifically when there are disruptions in maritime moving of ships across the globe. So coming back to Africa itself, the spotlight has really increased once again on Africa because the conflict really just exposed how quickly trade patterns can change when these established shipping routes become unreliable. And there's sort of a scramble for alternative ports, shorter turnaround times, and corridors for goods to keep moving. And we've seen some unexpected ports, maybe some small ones like Port Louis in Mauritius, that has been well placed to serve traffic between Asia and Southern Africa. And this has accelerated expansion plans that are backed by India at the port, which could strengthen the country's role in transshipment and bunkering. So these are smaller ports that are becoming important because of their location and because of not necessarily cargo handling, but the services that are associated with shipping and how they can accommodate that. Then we're also seeing in Walvis Bay, Namibia, that has been gaining attention as an alternative gateway into Southern Africa, mainly because South Africa's ports are just way too congested and those issues have not been resolved recently. So we definitely expect that the Gulf interest in these ports will remain, and my colleague Bilal has done extensive research into how Emirati companies have been leading this investment more recently. Then when it comes to corridors, lastly, we've got some exciting ones. I think the best known one is the Lobito corridor, which links the Copperbelt to Angola's port. And then there's also incentive in making the roads and the railways and border posts more efficient in other corridors across the continent. And one of these are the north-south corridor that runs through to South Africa. So many inland countries rely on that.
Zainab, thank you. And let's actually just go back to that refining image from earlier. And because we've got two questions that have come in, particularly on this whole idea of African refining capacity. First of all, the question is, where can we pick up a copy of this map The good thing is that we published a report on this just a week or 2 weeks ago, on African energy. So you'll be able to find it in your Insight membership. And in fact, that same report is also flagged in the monthly Insight, which was published just an hour or two ago. So 2 opportunities to get access to this map. Secondly, and I think this is a really interesting question, Zainab, and I've got some thoughts on this, but I'll give you a moment to think about it also, is given the lack of refining capacity on the continent, i.e. Africa, what is the net benefit for oil exporters as they still need to import some refined products? And when I read this question, for me, actually, Angola popped up, because the beginning of this crisis, immediately Angola was highlighted by many in the media and others, that Angola would be a country set to benefit from all of this, because they were stepping up oil and gas production, and in the climate of higher prices would be able to see a revenue windfall. We were a little bit more cautious at the time, saying, of course, it's undeniable that a country like Angola would see a benefit, but a windfall will be offset by the rising cost of imports, particularly, of course, refined products, but in fact, a layering of costs across the entire value chain in Angola, which imports pretty much everything. So we've seen Angola offset much of that windfall from the oil and gas sector. And simultaneously, the government has become more, has seen a real drive towards more economic diversification. And we've seen a new boost towards privatization as well. Not yet the big jewels in the crown like Sonangol, but certainly we've seen more of a push towards privatization. And that's perhaps also where economies, markets like Uganda, South Africa and others, which import and export, are able to offset some of these losses. Zainab, in terms of the countries that you've recently covered, there's a couple there which are both exporters and importers. Any thoughts on other examples that are relevant to this?
Yeah, it's important that you mentioned Angola, Robert, and I think that's as one of the biggest exporting countries of oil. That definitely comes to mind. But I think in terms of well, I think the question focused on other benefits that could arise for oil producing countries. And one of the major things is to invest more into infrastructure that support that. So like what we said, like the pipelines, the storage, that can sort of facilitate that exporting that we don't necessarily focus on when we just focusing on the refining capacity. So what I mentioned earlier is more the infrastructure that supports that surrounds that. And also things as simple as putting in systems in place that make it easier for goods to exit the country. So for oil to exit the country, like how do we make that more efficient so that there are less bottlenecks and that there are less chances of oil just sitting but nowhere to go. One thing that I would also say, and again, this is in the context of Angola, but is to move also away from debt for oil agreements, because when these opportunities come by when the oil prices are high, it's difficult to benefit from them when most of the oil is already tied up in existing agreements. So the benefits would more be to move away from that.
Agreed. Yeah. In fact, I thought of another example, Senegal, which I know our audience is very interested in as well. But actually, we need to move on to a different topic because otherwise we're going to be. But this is the refining webinar. Zainab, let's start looking at the next global crisis. Yeah, very, very upbeat message. I think we both agree that it's more than likely going to be access to critical minerals. Now, Africa has an interesting position here. What does Africa need to do to benefit from this race sustainably? And how will it impact investors? You know, local beneficiation versus resource nationalism, right?
Yeah, no, so the war has certainly strengthened the case for countries to move away from fossil fuels and more towards renewable energy, which has further benefits for countries that are hosts of critical minerals, mainly because these minerals are essential inputs for the technology that is needed. So this shift towards renewable energy, which Gabby touched on earlier, is something that is happening across the globe. And Africa is central to this, as it is, as I mentioned, it's a host of the minerals, but it is also needed to modernize these existing systems and to to not only to modernize these systems, but also to create corridors and place regulations into place where the governments can also benefit from this. So there's real value in African countries moving away from just being a supplier of the raw minerals, but to also play an active role in the supply chain itself and keep more of the supply chain home on the continent. And what we have seen is that the governments are trying to capture more of the value chain and push for more local processing and domestic ownership and also state participation. And we've already seen this in jurisdictions like Mozambique and Zimbabwe, which is home to graphite and lithium, which are essential for batteries that are needed for renewable energy. And these policies that these governments are adopting can concern private investors, particularly when they are introduced abruptly or when they create uncertainty over existing agreements. However, as we've seen the competition between global superpowers intensify for access to these minerals, and where we've seen a need to counter Chinese dominance of these mineral supply chains, we have seen that some investors are more willing to accept some regulatory risk that comes from this in order to get a foot in the door. But in saying that, the best positioned countries will be those that are able to increase value addition while also maintaining some sort of regulatory certainty. So South Africa is a long-standing example, but we do see that governments are pushing for strengthening their mining regulations. Most recently, we've seen Mozambique push for some local more local involvement, and at the end of the day, the US did not shy away from still getting involved. So Africa is really at the center of this new shift.
It really is, Zainab, absolutely. And this is worth a webinar on its own almost. So thank you very much for summarizing your key insights. And of course, again, we'll continue to cover those on the Insight platform. As our audience knows, our Insight platform currently provides quantitative risk ratings on all countries in the world, but qualitative analysis on the three regions we have covered so far: the Middle East, Asia, and of course, Africa. But later this year, we are hoping to expand our qualitative analysis also to the Latin American region. And already we've been looking at some of the secondary and tertiary impacts on the Latin American and Caribbean region. This is where I'd like to bring in our country risk analyst, Jack Brodsky, who's actually been looking at the Latin American region quite extensively recently. And Jack, maybe just to briefly talk about Latin America, which countries have been the most vulnerable during the past few months of war and energy supply disruption?
Thank you, Robert. It was very interesting as during the early weeks of the conflict, I remember reading different pieces suggesting that the Gulf War is not Latin America's war, different tropes like that. And of course, while geographic positioning means that the overall impact will not be felt as acutely in LATAM as in the Middle East, in Asia, or in Africa, this sentiment is of course not entirely true, as LATAM markets have not escaped the broader socio-economic effects of the closure of the Strait of Hormuz, notably in fluctuations in the prices of key commodities, as we've covered extensively on this call. Impact is not uniform in LATAM, predominantly due to the variation in import reliance, buffer stocks, as well as political stability. And I would say resilience has predominantly been tested in those countries that rely heavily on imports of food, fuel, and fertilizer, as well as those with the thinnest fiscal reserves. Of course, net fuel importers, for example, Costa Rica, Guatemala, Paraguay, have been forced to contend with higher import bills due to limited or no crude oil production or refining capacity. In a similar situation in Chile, these import costs have been transmitted directly at the feet of the consumer, with the price of gasoline nearly 30% higher than in February and diesel nearly 45% higher. While this sort of measures to mitigate fiscal balances and the impact on fiscal balances does place the burden at the feet of the consumer, which of course increases SRCC risks as well as political instability. Other countries, perhaps in a parallel way to what Zainab touched on just a few minutes ago, have a more complex outlook. And this is because there is the double-edged sword of having perhaps stronger crude receipts, yet that structural reliance on refined product import. Large producers, whether it be Brazil, Mexico, Argentina, or Colombia, do not have the necessary refining output to meet domestic demand, of course, limiting the gains that they can make from exports. And in Argentina specifically, gasoline prices have spiked considerably, with local media outlets reporting that there have been reductions in public transportation delivery, with between 20 and 40% of public buses being taken out of circulation, triggering long queues at transport hubs, and of course, adding to ongoing cost of living pressures. Public disquiet has also been exacerbated as the consumer price index reached an all-time high last month. Another perhaps final note of interest, which will have an impact later on this year, is that of food production. And we know that countries such as Argentina and Brazil, major agricultural producers, will be constrained by the disruptions to fertilizer shipments, some of which does come through the Persian Gulf and some of which is sourced from elsewhere. And of course, as you mentioned, we will be following closely updates as these countries will seek different solutions to try and mitigate disruptions to those shipments to bridge the import shortfall. Otherwise, later in the year, farmers will face troublesome harvests and cause a slowdown in a real key sector.
Indeed. Jack, let's put Latin America into the context of our webinar today, Global South Opportunities. What are the opportunities for Latin American countries coming out of the cycle of uncertainty? Can you pick a few that really see some silver linings here?
Yeah, silver lining actually, interestingly, would be in Argentina. And although we've mentioned some of the economic disadvantages experienced by the country, there have been some real positive trends that we saw since the start of the year. For example, central bank reserves have surged to their highest level in almost 7 years. Inflation pressure, although still quite high in sort of global terms, has moderated considerably from the 211% in 2023 down to 33% last month. And the IMF is still quite positive about the country's overall growth forecast, with the economy expected to grow by 3.5% over the coming year. And as a result, we've seen major rating agencies upgrade sovereign credit rating to B minus. Critically for Argentina, we saw how they made significant investments in previous years to unlock shale oil and gas exports from the country, which will provide a boost to the fiscal balance. And really these boosts to high oil output has been shown already in how much goods have been exported. In the first quarter, we saw Argentina export a 35% annual increase compared to last year, a new national record, which I think $9.5 billion. A second country that we've also been looking at is that of Guyana, which is one of the fastest growing oil producers. An ExxonMobil-led consortium has a strong presence in the Stabroek offshore block, and crude production is estimated at 900,000 barrels a day, with an aim to increase this to up to 1.7 million barrels per day by 2030. Notably, in a boon to the country, at the point that Exxon recovers its initial exploration and development costs, the share of the output and the profits received by the government will rise considerably from the current rate of 12.5% to the 50% mark, which will provide a significant boost to the country. I think looking ahead for Guyana, avoiding the pitfalls of the so-called resource curse will be crucial in avoiding long-term volatility. But if harnessed well, this mineral wealth and growth can really be a huge driver of economic progress.
You've given us a lot of Latin America content there already to kickstart the qualitative analysis expansion coverage. Thank you very much, Jack, for your insights on Latin America and the Caribbean region. And we probably have time for one, maybe two questions. And one question that inevitably pops up in this context is the resilience of the Gulf region in terms of investor confidence. Bilal, can I just bring you back in here? Has the conflict permanently changed investor confidence in the UAE, in Saudi Arabia's economic models, especially given their exposure to regional escalation in future?
Yes, Robert. To answer the question, quite frankly, I don't think so. Before the conflict, I think many investors questioned whether the Gulf's investment economic model story could withstand a major regional crisis such as the one that we just saw. And this was effectively the first real stress test for both countries, but they continue to actually function quite remarkably well. Neither economy experienced a loss of macroeconomic control. Also, financial markets remained orderly. Governments managed to continue to execute major investment programs, albeit with some changes and reprioritization of some of the programs that they've been running. Sovereign funding remained intact, and there was no sustained capital flight during this period, despite the nature of the crisis. If anything, the conflict is likely to reinforce the concentration of international capital into the strongest Gulf markets, namely here Saudi Arabia and the UAE. Investors are becoming more selective across the region, but that selectivity favors, in fact, Saudi Arabia and the UAE because they have demonstrated institutional capacity, a strategic depth, which is quite an important thing. A lot of the markets in the UAE has been diversified for the past decades anyways. But also policy continuity that we see coming out from Saudi Arabia and the ability to continue to attract capital during a period of regional conflict. So I think the security premium for the Gulf has not disappeared despite the nature of the conflict.
Thank you, Bilal. Indeed. And that's very much the message that we are conveying at the moment in our analysis on the Insight platform, on the Gulf War, on the Middle East, and all the different regions across the global south, in Africa, Asia, Middle East, and indeed Latin America that we cover at Pangea-Risk. At this stage, I would like to thank everyone who participated and joined us for this webinar today. I'd like to thank my team also for sharing their insights. And I'm going to hand over back to Gabrielle.
Thank you, Robert. Thank you all for sharing those insights. And of course, thank you to our Insight members for joining us today. We will make this recording available in due course. And of course, as Robert mentioned, much of this content is on our Insight platform. So please do log in to locate some of those graphics and some of our insights there. Thank you all and have a great day further.